Welcome to Smart Wealth with Joshua, and a very Merry Christmas to all our listeners.
Merry Christmas. It's great to be here for your daily stock analysis and catalysts talk. Today we're looking at Tilray brands.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, let's unpack this. We have to start with, I think, the most shocking piece of data here, that Q4 2025 earnings report. The earnings per share came in at 20 cents.
Right, and that figure is, well, it's almost unbelievable when you put it next to the expectations. The consensus was actually for a loss of 10 cents per share.
So hang on, they didn't just beat expectations.
No, not at all. They delivered a 300% positive surprise. Think about that.
300%. That's not just a small beat. That's a complete repudiation of the market's skepticism.
Exactly. And this isn't just about one quarter's numbers. It's a credibility moment. It signals that management's efforts on cost controls, on efficiency are, well, they're working much faster than anyone on Wall Street predicted.
It completely changes the narrative. When a company moves the needle that fast, it forces everyone to reevaluate, but the market always looks forward, right? So what's the next big catalyst?
The immediate focus is now locked on the next report.
True.
That's the Q2 fiscal year 2026 earnings, which is set for January 8th.
Okay.
Now, the consensus EPS is still projecting a loss around -6 cents, but it's the rate of improvement that has everyone's attention.
But a 6-cent loss is still, it's still a loss, so why the excitement?
It's the trajectory. It's because analysts are projecting an 86% increase in EPS for this report compared to prior periods.
Wow.
They're signaling huge confidence that the momentum from Q4 is continuing, even if the company hasn't hit consistent profitability just yet. It suggests the improvements are structural.
Structural. That's the key word. And that brings us to the macro environment. I keep seeing Schedule 3 popping up in all the commentary. For anyone who isn't tracking policy day to day, what does that actually mean for their business?
It's the game changer for their margins, a huge structural advantage. Right now, because cannabis is a Schedule I substance, Tilray is subject to Section 280E of the U.S. tax code.
Which means?
It means they can't deduct normal business expenses, things like rent, salaries, marketing. You can't deduct them from your federal taxable income.
So you can only deduct the cost of the goods you sell. That sounds like a penalty, not a tax code.
It is a penalty, essentially. Moving cannabis to Schedule 3 removes that restriction. Suddenly, all those operational costs become tax deductible. The benefit isn't just a little tax break. It fundamentally resets their margin potential in the U.S. market.
So a massive tailwind is on the horizon. If the financials are looking better and the regulations are easing up, let's talk about where they stand against competitors. They're a global company, right? Does that create a real moat?
It's their biggest advantage. It's all rooted in their global scale. And, just as important, their regulatory expertise. You have to remember how incredibly complex it is to operate in this space internationally.
Right.
This company has over 200 registered medical cannabis products. They're involved in more than 15 clinical studies around the world.
When you put it that way, it sounds less like a cannabis company and more like a biotech firm.
Precisely. And that level of IP, that experience navigating all these strict European and Canadian medical rules, creates a huge barrier to entry. A domestic competitor can't just spin up a compliant global supply chain overnight.
And that experience feeds directly into their U.S. strategy, I assume. How do they plan to leverage that foundation once reclassification happens?
They're positioned perfectly for a rapid and, crucially, a cost-advantaged entry. They're rolling out Tilray Medical USA.
So they can use their international supply chains to basically undercut domestic players on cost.
That seems to be the playbook. They can leverage the economies of scale they've already built in these other highly regulated markets. So when the U.S. medical market opens up, they get to skip that really painful, expensive startup phase that domestic companies are still stuck in.
It's not just cannabis, though. I notice a big emphasis on diversification. Beverages, wellness products, are those serious or just a distraction?
Oh, they're strategically significant. The revenue trends show real growth potential there. It's about managing risk.
How so?
Cannabis demand can be really volatile. It depends on state laws, price wars, you name it. The beverage and wellness side helps stabilize revenue when the core cannabis segment slows down. Plus, new product launches, like those Redeacon cartridges, they keep consumer interest high.
Okay, so we've laid out a pretty compelling bull case. Surprise earnings, huge tax relief on the way, a global moat. But The stock is still incredibly volatile. Let's talk about the bear case. What's holding big money back?
It all boils down to two things, really. Persistent net losses and an aggressive cash burn. Operations are improving, yes, but they haven't yet reached consistent free cash flow.
They're spending money faster than they're making it, so how does management justify that?
Well, they're leaning into it. It's a growth-first mentality. They're choosing to reinvest every dollar they can back into these high-growth areas.
So things like the U.S. medical expansion.
Exactly. U.S. expansion, new product launches. It's a deliberate choice to prioritize capturing market share now over showing a profit today.
Sacrificing today's profits for tomorrow's market dominance, that's a huge risk-reward bet.
It is, and it makes a lot of investors nervous. No dividends, no buybacks. It's all about growth. And the market has been burned by that kind of story in the cannabis space before.
There's also the regulatory risk itself. What if the reform just stops at Schedule 3?
That's the big one. If U.S. reform stops there and doesn't move toward full federal legalization for recreational use, it really limits their long-term growth.
Why? Wouldn't the medical market still be huge?
It would be, but the real prize, the fastest-growing segment, is recreational. Capping them at just medical would limit their total addressable market and, it would really put a ceiling on that multi-year growth story the bulls are hoping for.
Okay, let's switch gears to the technicals. This stock is famous for its wild swings. What is a recent price action telling us?
It's been extremely volatile, which is pretty typical for a stock in this situation. We saw a really strong monthly gain, about 23%, but that was followed almost immediately by a sharp fall of over 25%.
That pullback down near that $10 level, it looks terrifying on a chart.
It does. But a lot of analysts are seeing that as a classic buy the rumor, sell the news event. The selling was, well, impulsive. And despite that drop, the stock has been forming higher lows over the last few weeks.
Which is a constructive sign. It means buyers are stepping in earlier on each dip.
Exactly. And if you look at the indicators, like the Relative Strength Index, or RSI, that steep decline pushed it into what's called oversold territory.
Meaning the selling got a little out of hand.
It suggests the selling pressure became irrational in the short term. The pendulum swung too far, creating a potential for a technical bounce. The long-term momentum indicators, like the MACD, they still seem to align with the long-term benefits from rescheduling.
So where does this leave overall market sentiment right now? It sounds incredibly mixed.
That's the perfect way to describe it. You have these really bullish signals, the huge Q4 beat, the launch of Tilray Medical USA right up against the bearish views on cash burn and volatility. Institutional investors seem to be watching from the sideline, waiting for confirmation from that January 8th report. That report is the hinge point for everything.
The moment of truth. Okay, let's try to bring this all together for everyone listening.
When you connect all the dots, Tilray is positioning itself as one of the best capitalized, most globally ready players in the sector. They're leveraging their scale and regulatory experience to be the primary beneficiary of U.S. rescheduling.
And that tax benefit from Schedule 3 would be like pouring gasoline on the fire? It would immediately boost their margins?
Absolutely. Yeah. So the current volatility, while it's stressful to watch, it might be offering some pretty aggressive entry points ahead of that key earnings report. This combination of structural advantages and regulatory tailwinds, it really sets Tilray up for potential multi-year upside. The question for you is whether you can stomach the volatility to get there.
We hope this analysis provides some clarity on Tilray brands for you. For now, Merry Christmas, and we look forward to talking smart wealth with you again soon. Please remember to subscribe to the podcast so you don't miss our daily market analysis.